What is going on, everyone? Welcome back to the Figuring It Out Finance podcast. We have a great episode for you today with our first ever interview breaking down hard money with Matt Miller. So, before we get into this podcast, if you haven't listened before, my name is Chris Rickenbaugh, and I'm using this podcast to document my journey in real estate and business while also talking a little bit about travel hacking and personal finance. So you can find me everywhere on figuringitoutfinance.com. That's where you're going to find all the links to every episode of the podcast, wherever you listen to podcasts, Spotify, Apple Podcasts, YouTube, and then Podbean, where I post them. And then you can head over to social media on Instagram and TikTok, where I post daily about what I'm doing. So let's get into today's podcast. So, Matt Miller, how's it going?
Hey Chris, thanks for having me on, man. Everything's going great. Business is good. Everything's just wonderful. I appreciate the opportunity to get on here and talk about what I do, and how it relates to investors and what you're doing and how you're building your business up. So, looking forward to it.
Yeah, absolutely. So we got connected when I was looking for money to close on a deal, and we kind of hit it off because we were talking about a lot of different creative options that not a lot of people normally get into, and it wasn't just hard money. And you've set me up with, or you've connected me with a couple other investors, and we've hit it off with them. So I'm like, man, let's get you on the podcast. Let's talk about what you're doing, and I think you'd be a great first interview here. So tell us a little bit about what you do and your company.
Yeah, man, being the first one on the podcast, let's go. I
Yeah.
appreciate it. That's awesome.
Yeah.
Yeah, so my company is MGM Capital Investments, and initially I started off wanting to do wholesaling. I thought that was the route I was going to take. That's how I was going to do it. It quickly evolved into more or less lending on the lending side for investors because I saw there was a need there, that I could feel a little bit more efficiently than wholesaling.
Right.
So really what I'm doing right now is building up my list of investors who we do fix and flips, DSCR, long-term rentals, short-term rentals, midterm rentals, all of those type of things. But I wanted to grow bigger than that.
Mhm.
So I brought in commercial lending partners. I brought in business loan partners, trying to encompass everything so that way I can give my clients the best solutions for whatever they're looking to do.
Perfect.
Um, so, with that in mind, we do get a little creative. And like I said, we've talked some creative financing things. I've met a lot of awesome people who have helped me um, dive deeper and to really understand some of those things. So I just like connecting people and I like to be around people and help them. And so that's how I kind of got into this.
Yeah, that's awesome. And then, it's kind of like being able to have all those tools in your tool belt, right? Because, you're not just stuck with the 20% down investor mortgage. And then for normal home buyers, it's not a 20% down. There's all the FHA, there's VA, and, just being able to have all those options and then be able to provide that. Like that's perfect because a lot of like the general public, I would say, don't know about those things. So being able to, have that knowledge like you have and present it, you know, that's huge, especially for your business because you can grow so much better.
Yeah, absolutely, absolutely, and that's the thing. Coming from a traditional mortgage side, where I can provide multiple options for the same borrower, right? I can provide the FHA, the VA, conventional, all of those things, even non-conventional things. It really is what helped me drive into want to build this out as well. Knowing that I can help primary home buyers achieve their dreams, why not help investors who also have dreams and want to build things? So kind of playing off of both of those, that's really my main focus.
Gotcha. Now, do you own any rentals or invest yourself?
Personally, I do not. I
Okay.
do not. I am also in that boat where I am looking to get there.
Hmm.
So I wanted to learn as much as I could first, going through this side of it. And then when it's the time is coming, when I'm going to
Hmm.
jump in. Right now, I'm having a good time helping people.
Gotcha. Gotcha. So I know we brought you on to talk about hard money. So that's a big part of your business. Like you said, the fix and flips, the DSCRs. So that's mainly working with investors. So I wanted to break down just for all the new listeners, whether they're looking to get into their first flips, is, the big question, what is hard money?
Yeah, absolutely, absolutely. And that was one of the things that I didn't know when I first started either, because I was used to traditional lending, like this is just regular money. What is hard money? So I had to
Hmm.
look into it, right? And hard money in a nutshell is basically asset-based lending where we're giving you money not based on your personal qualifications necessarily, but more or less on the asset. It's to do something, it's to take money and to use it to do the fix and flips, to do those short-term deals is what it's for. It's for short-term deals, not long-term like a 30-year mortgage, unless you're doing a rental. But it's really generally geared toward private lending or asset-based lending. Um, that's the primary focus on it, where it's not necessarily your personal, but it's more or less for the investor side of things.
Gotcha. So yeah, I know I've used it for fix and flips, and it's basically that short-term loan, high interest. So, what are the normal people get caught up in the percentages of what the hard money is, but the biggest thing for using hard money is that it's a really good tool to not have to bring, 2 to 300 grand out of your pocket to be able to go flip one of these houses. So, if you could break down a little bit about, you know, using it as a tool to be able to flip properties. I'd like to dive into that because all these new
Yeah.
investors, that's what they're thinking. That's like, well, I don't have 300 grand sitting in my savings account. Like, how can I do this and then be able to use that to, make active income?
Right, absolutely. So like you said, there's short-term loans, usually between 6 and 12 months. Like if you're going to do a fix and flip, we're going to see 6 and 12 months, right? Like you said, higher interest rates, usually between 8 and 12%. Just kind of depends on the experience. They're quick closing, so you can close these things typically, depending on the deal, depending on title, really, right?
Hmm. Yeah.
Um, Usually we can close on 7 days typically if everything comes back good. Numbers are great. Less emphasis, like I said, on the credit is more about the property itself. And so even people with low credit scores can qualify for these if the numbers work out on the back end for the investment. Um, but would you don't need necessarily 20% down on these, right? There are some programs out there you can do as little as 10%. I've seen some that will finance the entire thing if the product or the deal is good enough. And experience plays a lot of factor into it. A lot of times I work with a lot of first time investors,
Hmm.
and we don't necessarily get the best terms, but you got to start somewhere. And so what we try to do is work out what is our best terms we can get for this first deal, knowing that the next one or the next couple are going to be better. So the first deal, you may have to put 15% down on it to get it to work, right? Because we want to make sure that our numbers and our ratios are in the right alignment. So saying that,
Now, does that come back on the loan to cost? So, like a newer investor would have, maybe not as much security because they haven't done it before. So, taking a little bit more as being secure on your side, you would have a lower loan to cost, meaning that they would have to bring, that 15% down just to make sure it's a safe investment for you.
yes, yeah, correct. You would sometimes we just base it off of risk, right? A newer, not as established investor who hasn't been through the process of renovation, because it can be easy, but it can also be a major headache and a major pain, right? And these things could take a lot longer than what you anticipate. Um, so, we kind of try to mitigate that risk of, hey, it may go over that 6 months, right? Or it may not sell. So we try to mitigate that risk as much as possible, but also trying to be here knowing that we're competing for others because other lenders and hard money and private money lenders are they're gonna have deals out there for people whether
Right.
we do or not. So we want to make sure that we're being competitive, but also at the same time mitigating our risk and also advising clients on like, hey, this may not be a good deal
Mhm.
because numbers may be off. So kind of want to.
Yeah. And I think that's so important because, if you're looking at a deal and say it's that first time and being able to bounce that off of somebody who's been in this business for so long, or looking at these numbers every day, they're like, hey, you might lose your shirt on this one, so the numbers just don't work out. I would say move on from it, and then it's up to that person if they move on. But so for one of these new investors, say they've been on bigger pockets, they've been reading the books, they're ready to get into it, they have a little bit of money or the private money raised to be able to go buy one of these, you know what do they need to be able to get in contact with you to get started on a hard money loan?
Yeah, so I did a lot of research on bigger pockets before I even started this. So I had to learn a lot of lingo, right? I had to learn a lot of that. So that's a great place for resource as far as learning and education. To get started, really what we're gonna look for, like I always tell people, if you have found a property, let's break down what that looks like as far as the purchase price, the renovation budget. What do you think is going to cost? Did you get somebody out there to give you an actual estimate, or are you just going off of what somebody else has said? The ARV, like let's look at the area, let's see what comps are out there, and let's figure out what this house will sell for renovated on the market. Uh, that's like the first. That's basically the first step, right? You want to evaluate and analyze the asset. What's it going to cost to get, renovate, and what's the aftermarket value or after repair value on the market, correct?
Right.
So with those two things, and then I like to set up an initial consultation with people, so that way we can dive into scenarios and we can dive into what they want to do, their goals. I like I'm not just here to sell you a loan. I want to grow your business with you. And so that's my main goal is to really understand your business, what you're doing, what your goals are. Um, so that way we can create a plan and execute that plan accordingly to how you like it.
Right. And I think that's so important as especially if that newer investor, they're brand new because that's building the trust with you. And then, how important is it that, you know, you've done business with one of these investors before and then they keep coming back to you. Do they start getting better rates or better terms the more deals they do with you?
I love it. I love to do that. That's the thing that I wanted to create the most is that relational business together. So of course, like if we're doing multiple deals, you keep bringing deals and stuff. I want to build in not just that relationship, but I want to build in reduction of cost because each deal is going to cost something. And so if we're doing a lot of business together, then of course I want to bring in some discounts on either whether it's the origination points or whether I can get an appraisal waived or something like that to incentivize you to return for one, but also to show appreciation. Like, hey, I appreciate you bringing that business back. So there's only so many things that I can do, but I can control some of the costs in it and help knock that out.
Right. And then when, so after they submit all their information, you brought up points and their terms. So normally, or what you do is you receive a big term sheet. It's going to have a lot of numbers on there.
Yes.
And so the biggest numbers, from what you're saying, are the purchase price, the renovation, and then what it's going to be able to sell for. So that ARV or after repair value, correct?
Correct, correct. Those are the top three that we're going to look at to initially underwrite the file, right? And then what you'll get, you'll also see things like your interest rate, the points, the long term. We'll want to know like the exit strategy, whether you plan to flip it, refinance it to for a long term hold, sell it, whatever you plan to do with it. But initially, what we want to look at first is the loan to cost. So most of the time, like I said, we can get between 85 and 90% of the purchase price, and then we'll fund 100% of the renovation. So you don't have to worry about the renovation part. You just have to bring the money for the down payment
Yeah.
for the purchase price.
Yeah, and that loan to cost, that was something I didn't quite understand in the beginning. It was just one of those terms. So, loan to cost, basically, it is your purchase price and renovation, and then times, say, let's just say they gave us 90%. So, they're loaning you $200,000 for the purchase price and renovation, 100%, and they give you a loan to cost of 90% or 90%. So that means you would be bringing 10% to the closing table, correct?
Correct, correct. You're going to
Gotcha.
bring it. So a couple of my lenders do it a little differently. A couple of my partners. Some will do 90% of the purchase price, and then that's it. That's the down payment. And some will combine it, and they'll do 90% of the purchase price plus the renovation. So it just kind of depends on how it's structured and which partner gives us the best terms. Depends on which route we take. Oftentimes, it's not really that much of a difference, but sometimes it can make a difference. But yeah, back to what you were saying, typically adding the purchase price plus the renovation together. So, like I said, on a $150,000 house with a $50,000 renovation budget, you're looking at $200,000 all in cost. So we would take 10% of that as a down payment. And so you'll be bringing $20,000 for down payment, uh, and then financing the rest.
Gotcha. Yeah, that's super simple and easy to remember. And then, so like going through a couple of the other terms on that term sheet, points. So that's another one people would try to glance over, and then the interest percentage, because the moment somebody sees 12%, they freak out. But first off, they don't quite understand what it means. So let's start with origination points and how that factors into their payments.
Absolutely, absolutely. So origination points, just like in traditional lending, is one origination point equals 1% of the loan amount. Not the purchase price, not the purchase plus the renovation, but the actual loan amount that you're qualified or that you're getting. So oftentimes what you'll see on hard money loans is that's where they make the money. They don't make the money on the rest of the stuff. They make the money on their origination. And that's how the lenders continue to build their equity, right? So the origination fee is typically between 1.5 to 3 points. So 1.5 to 3% of the loan amount just kind of depends on again experience, relationship, and overall outlook of the deal. So and most of the time I'm seeing 2 to 3% for those origination points. Those are a fee that is added. So some of my partners will only have the origination, some will have an origination, and then you'll see like a loan doc fee or an appraisal fee or some other fees like that. Um, it really just depends on how they set their programs up and what they do for
Gotcha. Yeah,
their
because I
borrower.
know when I started, I was doing like 2.5%. And then finally, after doing two or three, they bumped it down to two. And we're like, yeah, that's awesome. And it's like, I don't quite know what that means. But um, yeah. And then, so the interest rate. So normally, like you said, they're between, or
I
the,
would, I would say I would say between 10 and 12% realistically on a hard money loan. If you're looking at a DSCR or rental loan, you're gonna be getting a little bit better of a rate because it's a long-term loan. So you usually can get those between 7 and 8%. But for a fix and flip, you're gonna be looking probably 10 to 12%. Same factors based on experience, based on relationship and based on the deal itself. Some are just hard and fast at 11.99%. I've seen that no matter what the deal is, but they'll sway a little bit on the points, maybe.
Hmm.
Uh, but the interest rate, that's typically it. And I know a lot of people will look at that like, I'm not paying 12%
Yeah.
on loan. But for the fix and flip loans, you're paying interest only for the however long you have it. So we set these things up between 6 and 12 months, right? Because we want you to get in there, get it done as fast as you can, put it on the market and sell it. So we can get it off our books and you can get it out off your books. And so you're ready to go to the next one. So these aren't long-term commitments. Oftentimes people get them done in 3 months. So they really only made three payments on this loan at 12%. So it's not like you're going to be paying 12% for 30 years because it's really max 12 months. It really depends on the deal. So in the grand scheme of things, it looks really bad, but once you break it down to what you're actually paying, it's not as bad as it sounds on paper.
Right. And I remember, so when I was raising money for one of my latest flips, they just wanted to see, we brought up the term sheet. I'm like, hey, this is what I get. Here's how I know how much the money's going to be able to bring to the table. And were freaking out about 12%. And I'm like, you kind of, it's like, yes, that's a part of it, but you're also getting a loan for this short of time. And they're giving me, let's say, $200,000. So it's like, we kind of have to brush that off. But
Yeah.
you brought up the DSCR and the refinance, and that's talking about exit strategies. So, um, being able to, we probably don't have a whole lot of time to be able to break all of those down, and we can definitely have you back on. But thinking about the exit strategies to say, hey, whether, let's think about bigger pockets. They do the BRRRR strategy. So buy, rehab, rent, refinance, and repeat. So being able to take that money out if they bought the deal deep enough, what are, the refinance and the DSC are two options. So, putting those two together, what are the main differences between the DSCR and then a straight cash out refinance?
Well, if you what you want to do, a DSCR is debt service coverage ratio, in case anybody was wondering, like, what's all this words? I don't know what all these letters
Yeah.
mean. Like, so essentially, what a debt service ratio loan looks like is, does the rental income cover the mortgage? That's what it looks at. They go into a little bit more detail. They want your credit score. They want some other things, but essentially, in a nutshell, if the income covers the monthly mortgage payment, then that's what qualifies the property. And so when you go into these deals, oftentimes you want to go into them with an exit strategy in mind. There are some people who just solely fix and flip. They don't want to hold any rental properties. They just want to fix them, sell them for a quick profit, and then move on to the next deal. Some like to either buy properties that don't need to be rehabbed. They just are good opportunities for a rental because you can either do a short-term rental like an Airbnb, a midterm rental, which is getting actually increasingly popular around the Charlotte area, and or long-term rentals, which is your 12 months plus. So either people are buying them as is, ready to go, turnkey, or they're doing the BRRRR strategy where they buy it, they flip it, then they get it rented out and we refinance, get the equity out of it, and then do it again on the next deal. The biggest difference in, I guess, doing the DSCR refinance versus say you didn't do that, you just did it. A conventional cash out refinance is the conventional cash out refi is going to go against your debt to income ratio. They're going to look at tax returns. They're going to look at all of these other things as if you were buying a house, right? Your primary house. They're going to look at all of these different things.
Right.
The DSCR streamlines that process, says we don't need your taxes. We don't need your income. We only need to know if the property itself is going to cash flow. And there are times where the property itself doesn't have to cash flow. You can still get a DSCR loan. You can be below what they call as a 1.0 ratio, which means that your uh, income is equivalent to the mortgage. Obviously, we want the income to be higher than the mortgage payment because that gives us less risk, better return on your end, better cash flow. But sometimes to get one established, you have to go below that 1.0 ratio. And oftentimes you can't find anybody to do those. There are some that will say, hey, you know what, we're going to take a risk with you. We know that this is going to increase in equity or increase over time. So let's go ahead and get this locked in. Even though it's below, it's not cash flowing immediately. And
Right.
that's a go
Yeah.
ahead.
Yeah, and I think those are great strategies because, like you said, the refi is going to require all of this documentation, but the DSCR you can go straight off that income's properties. So, for these new people getting into real estate, looking to raise money for their first deal, the way I've started using it and then told other people how to use it is that, hey, you know, everybody who's giving you money is asking how are they going to get it back? How are they going to secure their funds? So let's say your property takes 2 months to renovate and now you have 4 extra months and let's just say it is not moving. It is not selling. That's one of your exit strategies to be able to say, hey, if we don't sell it by this time, we always have the ability for one of these exit strategies at say the DSCR and then it's back on you. Obviously you don't cash out of it, but if you're buying them right, then you're not going to be in the hole on those properties. And then now you have a rental, whether it's hopefully it's cash flowing. So and that's how we're looking at them right now. And it's awesome to be able to talk about those other strategies. So are there any other exit strategies you can think of, just off the top of your head that some of those investors could use, say if they're coming up on their 6 month deadline?
Yeah. So here I've gotten this question a lot, and I've gotten a lot of investors who come to me in the 12th hour, right? They're like, hey, we have 15 days and this note's due to our money lender for this flip and we can't sell it. Like, what are our options? Oftentimes, if they really want to sell it and they're not, trying to hold on to the property, they can ask for an extension from the hard money lender. It will come at a cost if they do get one, but oftentimes the hard money lender is like, hey, this property is done. We're just waiting for somebody to buy it. So I always would suggest try to get a 3 month extension if possible. Just to give you some more time. If it doesn't move then, let's look at refinancing it into a DSCR. Let's just hold it and see if we can rent it. The only, I wouldn't say the only, but one of the major downsides to a DSCR, and we haven't mentioned yet, is the prepayment penalty.
Hmm.
So the prepayment penalty is usually set for 0, 1, 3, or 5 years. And what this means is if you refinance or sell or modify the loan by any means within those timeframes, then you're going to owe a certain percentage to the lender to modify the loan. Um, Obviously, everybody wants to know prepayment penalty, right? Nobody
Yeah.
wants to have any extra penalties. Say the rates drop by 2% and you want to refinance out, right? You don't want to pay an extra 2 or 3% just to do that. But at the same time, the longer the prepayment penalty, the the lower the interest rate is typically, and the less the points are charged for the DSCR loan. I know it's jumping way to the other side of
Yeah.
things, but that's just one of the things that you want to look at if you are going to refinance out of a flip into a DSCR loan is like, how long are you planning to hold this? Because if you plan to hold it for, 9 months, then let's see, what strategies we can do. So I like to bring in a holistic view of everything. I like to lay all the cards out on the table. Like, what is our plan if this works? What's our plan B? Do we have a plan C? There's always a way out. It's just a matter of which step we need to take first.
Gotcha. Yeah, that makes sense because uh, we actually just had to, use one of those. We asked for the 3 month extension on my latest flip. That was a headache and a half. So finally under contract to sell that one.
Oh,
Oh,
good job. Awesome.
yeah. Oh, yeah. That one had me sweating. First one. So, yeah, and we were starting to look down the DSCR route too because it's like, all right, well, this is a 5 bed, 3 bath, 1942 square feet. It's like we could easily do rent by the room, add another two. It's like, all right, what are we looking at now to be able to do one of these if we have to? And now I have another property coming up that I talked to Pad Split, and they're like, yeah, dude, if you want to do this, like this is gonna be a killer pad split. You know, you're gonna have 6 to 7 rooms in there. It's by the buses, it's by the highways. So we might be hitting you up here soon
That's
about
cool.
that, depending on where the numbers look. But Matt, I appreciate you taking the time out of your busy day here to hop on the podcast with me. And closing out here, where and how is the best way to reach you if somebody in your area, the North Carolina area, wants to work with you?
Yeah, man. I appreciate it, Chris. Thanks for having me on. I hope we got to talk about a lot of stuff that you wanted to hit and
Yeah,
that your listeners wanted to hit. If not, we will hop on and dive deeper in some other things.
for sure, for sure.
My website is mgmcapinvest.com. That is where you can find out more information about everything that we're doing here. Email is matt@mgmcapinvest.com, and my phone number is 980-500-9823. And I am available for whatever you need to do. We can talk strategy, we can talk financing, um, whatever. I'm here for it.
Awesome. Well, I appreciate it, Matt. And this is going to be all for this episode of the Figuring It Out Finance podcast, releasing on Friday, February 14th, Valentine's Day. So I appreciate you tuning in, and we will be back on the next one.